And with that, let's get started with our workshop today. Quick housekeeping. During the session, I'm going to request you all to keep your mics muted, cameras switched on, so we can make it nice and interactive. For the question answers, you feel free to drop in your questions in the chat or use the raise your hand feature to ask us questions. We will be stopping at different sections to address your questions. And now, without any further delay, I would like to introduce our amazing speakers for today, both from Fasken, a leading international law firm, Kate Grant, who is the business advisor at Fasken and is extremely passionate about technology and entrepreneurship with a background in ecosystem development, strategy, VC, innovation, and product. She has successfully helped build and grow early stage companies throughout her career. And joining her today is Satnam Singh Dosanjh, who is an associate in the firm's emerging technology and venture capital group. And he has experience in all aspects of private and public commercial transaction. He represents both investors and founders of early stage companies, guiding them through the organizational stages through various rounds of financing and ultimately towards successful exits. Kate and Satnam, thank you so much for being here today, and I welcome you both to begin the session.
Awesome. No, it's great to be here. I worked with the Y Space before, and particularly with the BEA and Y Space collectively, and it's been an amazing experience. I think everybody that's part of the organization is great. So happy to be here and let you know what little noodles of information I have. Kate, if you have a couple quick introductory notes, you want to throw them out there?
Yeah, for sure. I'm going to share my screen. And similar to Hashim, I keep calling you Hashim today, I'm sorry. Similar to Satnam, I'm really happy to be here. We've been working with Y Space for many years now, so it's really great. Can everyone see my presentation? Just give me a thumbs up. Awesome. Alrighty, let's get started. So as introduced, Satnam and I are here from the team at Fasken. We both work within the emerging tech practice. So broadly speaking, emerging tech at Fasken is about 80 people across the country, and we focus on startups just like you folks. So we really want to make this conversational today, and we really value that you're able to join us, especially over the lunch hour. This is your time though. If we say something that you're like, I have no idea what that term means, or I have a question, please feel free to raise your hand. As mentioned, we really do want to make this a conversation because, to be honest, nobody wants to listen to Satnam and I just talk at you for an hour. So today we're going to talk very quickly.
Debatable. I think people will listen to me for an hour for sure. I don't know about Kate, but let's.
Wow. That's because I called him Hashim. Hundo P.
Yeah, there you go.
I will also note that I have a really bad migraine today, so I popped one of my migraine pills, so I'm a little bit woo-woo, so it's gonna be fun. But basically, we're gonna talk a little bit about our incorporation, governance, capitalization, fundraising, the due diligence process, and then we'll open it at the end as well for Q&A. But again, feel free to pop in. So we do say this at the top of every presentation. This is not legal advice. If you have something that's very specific to your company, a legal matter that, is very time sensitive, just reach out to either of us or any of the team. We're happy to take things offline. We're always happy to have a conversation and make sure you're getting the right guidance. So our contact info is at the bottom of this presentation, but we can share it in the chat as well if you do have something specific. I talked a little bit about who our team was already, so we can just skip this. I'm going to hand it over to Satnam. Why don't we talk a little bit about incorporation governance, and then we'll get really into the meat of the presentation.
Sure. So just to give everybody a quick overview of how we're going to approach this, we want to focus more on the fundraising aspect. So we're going to talk about a couple of instruments. We're going to talk about a SAFE round, a convertible note financing, and a preferred share financing round. So that's what we want to focus on, but we do want to lay a bit of groundwork as to what it means to be a venture style corporation and the things that you want to have in place so that when you do go do these fundraisers, investors are going to ask to see your data room and they see something that they're very familiar with and it'll accelerate their due diligence process and increase their confidence in investing in your company. I do have the chat open on the side, so as Kate mentioned, if there are any questions as we're going through this, please feel free to throw them in the chat. And if we're moving through anything a bit too quick, we're happy to like take a pause and answer that. Also, like, great shout outs from Nafis here from Y Space, just in the chat too. Appreciate it. All right, so we're just gonna get into it. Kate, if you could go to the next. So what is a corporation? Just at a very high level, it's a separate legal entity. The corporation itself is going to own the assets of the business. The corporation must pay and file taxes. There's accounting aspects that get involved in this that will determine how much you owe in taxes, if any. So, a big part of opening up a startup is making sure you engage other service providers that help you as well. So it's legal and accounting. The corporation itself can hire employees, contractors, advisors, and there's different ways to engage them that we'll gloss over. The corporation itself can enter into contracts with other entities. You as a person can as well, but then any liability under that contract will go to you versus the company. So, if you own your house and somebody wants to sue your company because it's the counterparty to the contract, they can go after the company and any assets they own, but you've essentially separated yourself legally from that. So your personal assets wouldn't be subject to it in most circumstances. Next slide, please, Kate. The incorporation process, what it's going to set up is that you're going to set up your shareholders. The shareholders share in the profits. They approve certain decisions that the statute requires them to do. So the main ones we'll think about today is the Canada Business Corporations Act and the Ontario Business Corporations Act, which we're both qualified to speak on. They're all pretty similar, like the OBCA and the CBCA are quite similar, but there's certain nuances that are different. But under each respective act, there's things that require shareholder approval, things that you can do without shareholder approval, things that require a certain threshold of shareholder approval. So you really need to rely on the act, and it's our job to know what's required to do, what, and we'll actually incorporate these things into the shareholder agreements so that we can contract out of certain CBCA requirements that makes it easier to run your startup. So we'll talk about like a concept like a voting drag, but that's essentially something that the startup world has incorporated into their underlying documents, because this type of corporation has a lot more shareholders than your typical corporation. That's just like a brick and mortar type operation that's kind of family owned. You're also going to want to appoint your directors. The role of the directors is to manage the business, provide general direction, and to make major decisions. And then you have your officers who run the day-to-day operations. Think about like a chief financial officer, chief technology officer, things like that. They propose strategies and objectives, and their job is to kind of implement what the directors put in place. Oftentimes, the directors and officers are one and the same. So essentially, the officer ends up kind of just being a title. So generally, a founder will be a director and the chief executive officer, and things like that. So we could move on to the next slide, Kate. In the VC world, there's three, not just the VC world, I'll say this VC and startup world, there's three underlying shareholder agreements, and they're going to be called the voting agreement, the right of first refusal and co-sale agreement, and the investors' rights agreement. These get put into place when you have your first preferred share financing. There's also, in a lot of cases, we'll put these in place right at incorporation, but instead of an investors' rights agreement, as you see on your screen, there'll be a shareholder rights agreement because there's no investors yet. The market's kind of moving towards just putting a unanimous shareholders agreement in place at incorporation. because all of it gets negotiated anyway. So you can find resources on like the Canadian Venture Capital Association website, and they'll have all of these things there as model templates. The way the ecosystem works is that they want to keep costs as low as possible, both legal costs, financing costs, things like that. So we try to operate on the industry standard templates. It's not always the case, but the goal is that everybody that operates in this space kind of works off the same agreement so that we can do financings faster and cheaper. We're in the startup and technology space. Like everybody wants to make everything easier, faster, and more accessible. So that's kind of the goal that's been created out of San Francisco some 20 years back. So the voting agreement itself, it's going to cover who's going to be on your board. It's going to have drag along rights. So I mentioned earlier that there's certain things that require certain shareholder threshold to do. We've put into our voting agreement, and the industry has put the concept of a voting drag, where once you hit the statute required minimum to do something, that through a power of attorney, the rest of the votes can be dragged along. So let's just say the statute requires 66%, so 2/3 of your shareholders to agree to something. If 2/3 of your shareholders agree, and there will be additional protections, such as that 2/3 must include the founders, or it must include these special shareholders. Once that threshold has been hit, we can pass a resolution where if everybody else that doesn't vote within a certain time frame, typically 48 hours, if they don't vote within that timeline, then we can drag that vote. What that does, it allows you to operate your business in a more efficient manner. There's always, I can't tell you how many times I've seen the situation where such a concept wasn't put in place, and a closing of a financing or something might be held up by an extra week or two, and it could be an angry ex-shareholder, well, an angry shareholder that's no longer part of the company, or it could be simple as you had an early family member who's now 80 years old invest in your company, and they don't check their email every day. They're not going to check it for a week. They're not going to check it for a month, but you need their signature to get something done. So this concept allows you to work around that. Once again, any questions while I'm saying this, please just enter it into the chat, and I'll address it as we go. The second shareholder agreement is the right of first refusal and co-sale agreement. What this does, it allows you to protect your capitalization table and your shareholders. So if I'm a shareholder in your company and I want to sell my equity, you don't necessarily want this third party to come in that you know nothing about, but somebody was able to sell their equity on the private market, and now all of a sudden you have this new shareholder that you don't know how they're going to operate. What this does is it adds a protection that if you're selling your equity, if you decide you want to sell it, first you have to offer it to the company. If the company doesn't want to buy it, then you have to offer it to like a certain protected shareholder class. So it could be the major investors in your company, right? If they don't want to buy it, it goes back to the company. If they don't want to buy it, the shareholders get one more go, and then you can go out. So there's like certain protections to make sure that you can control who is a shareholder in your company while you're private. Obviously, this doesn't apply once you enter the public marketplace. And then the other protection is a co-sale right. So if it goes through that process and somebody is selling their equity, and let's just say it's a major shareholder that owns a significant portion of the company, and it makes you want to sell your equity as well, you'll be able to sell your pro rata portion of that. So if somebody's selling, 60% of the equity that they own, you should be allowed to sell 60% of the equity of the equity that you own. So that's a protection that's put into place in the venture style documents as well. So I had, just to answer your question, the business models from California, it's different from local legal advice. So like you gotta understand, like we're more of a transactional world. Like what I do here is almost identical to what people do in California, New York, San Francisco, places like that. We follow the same principles, and there's going to be some tweaks, obviously, to account for local business regulations. So there are, like, if you're doing something in a different state or different province, even, like, you need local counsel there to advise on certain nuances, but overall the practice is, it's a transactional practice. Like a corporate M&A lawyer here does almost the exact same thing somebody does in New York, California, other states. And it's the same thing in our world, in the venture capital world. And Emma, do we need to draw up all three of these agreements when we were still in our bootstrapping phase? No. And the industry standard has kind of moved away from it, where in the initial phase, we just put a simple shareholders agreement in place now, and this is what Fasken is doing as well. If you're coming to us with a brand new company that needs to get incorporated, we're just going to put you on a simple USA, so a unanimous shareholders agreement, because all of it's going to get negotiated at the seed stage anyway. So it's moving away from that. The practice for the last 6, 7, 8 years has been to just put these 3 agreements in place right away and renegotiate them. So the next one I was going to speak about was the investors' rights agreement. This one starts off as a shareholder rights agreement, and then it falls off, and then it's replaced with an investors' rights agreement. And only people that have preferred shares, so your preferred shares as investors, that agreement is only specific to that. And it'll provide for preemptive rights. So if, like, the company's offering new securities, they want to have certain rights to purchase them. Registration rights, that's going to be if the company ends up IPOing, what rights do you have to list amongst them? And then there's protective provisions, which limit what the company can do without a certain class's approval. So it'll say, like, we don't want you to increase your stock option plan because it'll further dilute us without us agreeing to it, or at least one of the preferred directors agreeing to it. So to answer your question, Imad, no. You're going to get some lawyers that do, some lawyers that don't, but all to say, the industry standard is moving towards just putting a more simple shareholder agreement in place at incorporation and just negotiating these 3 agreements when we get to a preferred share financing round. Okay, just gonna move on. Some general securities law rules. You can't issue securities unless you rely on a prospectus exemption. This becomes important when you're raising like a friends and family round. It's laws that have been put in place to protect the general public from investing in companies that they may not necessarily be qualified to invest in. So there's certain exemptions that you have to hit. An accredited investor, there's like a slew of criteria that you have to hit to be considered an accredited investor. It could be you've had a salary of like $200,000 or more for the last 2 years. You have assets excluding your primary residence in $5 million or above, or like $20 million. There's different classes. So you want to make sure that anybody that's investing in your company falls under one of those exemptions. And there's obviously friends and family exemptions as well, but you do want to make sure that they qualify under one of them. It's put in place so that, like, some poor old grandma or grandpa isn't taken advantage of. Somebody goes, they're like, oh, you can really make a lot of money in the next like 5, 6 years if you invest in my company now. And they've taken $10,000, which could be all their savings, and put it into your company. And all of a sudden, nothing happens with the company, and this person just lost their $10,000. They should be able to tolerate the risk that's going to come with their investment. And so these exemptions are put in place for the company to actually accept money. Private issuer exemption is if you have 50 shareholders or less, and you're not publicly listed, you can qualify as a private issuer. The advantages, there's a couple tax advantages that come with this. There's the concept of lifetime capital gains exemptions. You don't have to file a lot of securities filings after doing a financing, if so long as you're under 50. So there's a personal tax advantage to shareholders. But also from a cost perspective, these security filings can add up. So if you have an American investor, you're going to have to invest in it. You're going to have to like do a security filing in certain states that they operate on, and you're engaging more and more lawyers. And as people are aware, we're very expensive, and the filings are also very expensive. So to the extent that you can avoid that by controlling your cap table and keeping it under that 50 number, you should. And the places that people can get lost in this is that at the earlier stages, when they're trying to raise money from wherever they can get it, you might find yourself like, okay, I have 20 different safes now. All those safes are going to convert one day. And all of a sudden you have 20 brand new shareholders. You might not have it at the point in time that you issue the safes, but you have to account that like, okay, you have 20 future shareholders in your company, and you might have a preferred share financing round where you get in like 10, 15 people, right? So all of a sudden you're very close to getting over that private issuer exemption, and you'll lose a lot of tax advantages. There's people that you can issue securities to that won't up your private issuer exemption. So that could be directors, officers, and employees. And then there's a consultant exemption as well, but the contractor exemption doesn't apply to the private issuer. That's a separate exemption. A general resale restriction is that the first trade has to be pursuant to some type of prospectus or an exemption. And secondly, you can't sell a security that you have before the date that's 4 months after you acquire it. So that's just to kind of protect you and the company as well from somebody that might go in thinking, oh, I'm going to buy this stock and then I'm going to flip it in like the next 2-3 months. They can't do it until 4 months. It's still a relatively short period, and I haven't seen many situations where people do try and sell something before the 4-month period. People generally understand that it's a long-term game. But that's just a general securities exemption. If somebody comes in thinking that they can flip it, you can just tell them like, well, you actually can't until at least a minimum of 4 months. And once again, all that resale will be subject to your shareholder agreement, such as the right of first refusal and co-sale. If we can move on to capitalization. I'm just going to run through this pretty quick. Capitalization is essentially who's on your cap table. So there's a concept of diluted and non-diluted and fully diluted. A fully diluted cap table will take into account anything that's going to convert into equity at some point or another. So if you issue options in your company, if that person chooses to exercise them one day, they'll be part of your cap table. So a fully diluted cap table will take into account issued options, non-issued options. It would take into account outstanding safes, outstanding convertible notes, outstanding warrants, because they all have the potential to convert. So a fully diluted percentage would reflect what you would own if everything converts, whereas there's a present day, so that'd be a non-diluted. If you take a present day snapshot, it's like, well, today you own 80%, but once everything here converts, you'll own 40%. So that'd be the difference between diluted and fully diluted. If you issue shares in the company or convertible security, so convertible security will be your safes, convertible notes, could be a warrant, options. Anybody that holds equity in your company is potentially diluted. Once again, people can choose not to exercise their options. People can choose not to exercise a warrant. People don't have to, if for some reason or another, the company never gets to a preferred share financing round, the safe might not convert, right? So there's a variety of factors that could result in you not getting further diluted. But the idea is like, hopefully, like if you invest in a company or somebody invests in your company, it's because you're going to get to the point where they can eventually become shareholders. And it's good to track as you go on. And there's two approaches that people take here. They can either manually update. A lot of people do that. It's easy to mess up and lose track of who is doing what. If you're at the point where you're issuing equity and options to anybody entering your company, right? It could be every month you're issuing out new options. you need to like manually update your cap table to account for that. But there's a lot of tools out there in the world that you can use. So Carta is a great example. Carta has cap table management where you can, upload everybody that's part of your cap table now. And anytime you issue options, it'll automatically like calculate your cap table as to how much they own, when these options are going to invest, if they've exercised anything. Same thing with safes and things like that. You can pull cap tables straight from there. Mantle is another one. So there's a number out of there. We have relationships with a lot of them. So if it's something you're interested in, please do shoot myself or Kate a message, and we can definitely make some introductions. Next slide, please, Kate. A lot of the equity instruments in the venture capital world do have repurchase rights and reverse vesting. So this is typically, it'll be more limited to founder shares and options. So a repurchase right is a company's right to repurchase the equity. And sometimes not just the company, it could be the investors, but in most cases, just the company. Think of it of a concept where you have a co-founder and you guys both, you decide to embark on this journey together, but you don't know what's going to come up. Like life happens, your relationship might sour between you two, and all of a sudden you don't want somebody to walk away with 50% of your company. So with the concept of reverse vesting, market standard is typically about a 4-year vesting period with a 1-year cliff. What a cliff means is like your equity will continue to vest for that 1 year, but if something happens before that 1-year period, where if you leave or you get terminated or you stop providing services to the company, which is obviously a pretty subjective interpretation as between the founders, you want the right to repurchase that equity so that there's not just somebody out there that owns all this equity that they got for nothing, because when you start something, your equity is worth nothing. So you're almost buying it for 1/5 of a cent per share. So you could have owned half the company for $5, which one day hopefully is like a $1 billion company. So you want to avoid these situations. With the reverse vesting concept, your equity will continue to vest over that 4 years, and once you hit certain timelines, you'll just get a higher and higher percentage of your equity. From a company perspective, this protects the company in that you don't want somebody, as I said, to just leave with a bunch of equity. By having them on a reverse vesting agreement whereby it vests over 4 years, if they truly want to take advantage of all that equity, they're going to be there for a minimum of 4 years. From an investor perspective, and sorry, if they leave, the company can repurchase that equity. From an investor perspective, it's going to be like investors are investing in the founders at the earliest stage. So at the earliest stage, say Kate and I are founders of a company, they're looking at us. They're like, okay, we believe in you two. You guys are going to create this thing. But if I leave in a year, like they might not think only Kate can do it or only I can do it. So they want to ensure that these early founders that are there for the long run. And by putting them on reverse vesting, you ensure that they're there for a specified period of time. That reverse vesting, once again, there's an industry standard of 4 years, but it sometimes gets negotiated higher or lower. It's the same thing for people that you bring on as employees and you grant options. The options generally they'll vest on that same schedule, so 4 years. And for you as a company, that ensures you that okay, somebody's not coming to my company just to get a quick percentage point of my company and just walk away. You want them to have to earn that. And it's hard to hire employees, but if you hire someone and in the first year you figure out that they're not really working out, you can terminate them and you haven't diluted your option pool that you use to grant equity and bring people in. Imad had another question here. How can we remove the subjectivity you mentioned from the contract? There's a very specific, there's a very detailed definition of what providing services to the company means. But very honestly, like this does end up just being an interpretation between founders. Oftentimes, it ends up being a negotiation when somebody decides to leave as to what they're going to get. Sometimes, like we just had a company that one of the founders just got sick, and he had to take a step back and didn't hit the 1 year cliff, and it was just understood. If there's a situation where there's no bad blood or anything, then they'll probably step away, understanding like, okay, I can't really do anything for the company anymore, and I'm going to take a step back, and whatever the documents say, we're okay with that. If it's not a great exit, then more times than not, even an employee will cause up a fuss about like, oh, I was still doing this, I was still doing that. So it's very contextual. It's going to be on a case by case basis, but for the most part, it's pretty clear when somebody's not providing services to the company anymore, and the definition itself is where it's covered, and it makes it pretty clear what it is. But once again, it could become like a he said, she said kind of thing once you get to the actual point in time where you either have to make a choice to terminate somebody or they're deciding to leave and they want to negotiate how much equity they're going to leave with. Okay, we'll quickly go to the next slide here. We briefly covered the option pool, so just very high level. It's a certain percentage of your your capitalization that you've set aside to incentivize people to work part of your company. Startups, obviously, at the earliest stage, don't have the same capital a more established business could have. So a lot of people accept a lower salary, but with stock options to kind of up their interest in working with their company. So that's something that gets negotiated amongst various levels. Whereas like, oh, I want to, I should be given this much equity because I'm doing this, that. So oftentimes like we'll set aside anywhere from 5 to 15, 20% at the outset, depending on what you project your hiring needs are going to be. And then that'll get renegotiated every time you have a financing round. So it could be like, okay, post financing, we want to continue growing. We want to make sure that you maintain a 15% option pool. That'll be input into the calculations for what everybody wants their ownership to be post financing. So if you know that you're going to have a 15% option pool post financing, you can have clarity on what you'll own once this new money comes in. Okay, so now let's get into the meat of fundraising. There's two types of fundraising. There's non-dilutive and dilutive. Non-dilutive, there's a bunch of grants available. It's just money. They're not asking for a chunk of equity in exchange for the money. In Canada, there's SHRED credits, so scientific research and education. ED, education, no, education, scientific research, and Kate's gonna find the unmute button, and then there you go.
Yeah. It's science research.
Experimental development.
Yeah, that's what it is. Development.
There you go.
Yeah.
So it's actually one of the biggest advantages of having a startup in Canada is that you have access to SHRED credits, and there's a bunch more. So there's a big push right now for IP to be developed in Ontario and Canada generally. So there's a organization called IPON, IP Association of Ontario, and a few others where you can kind of pull together separate grants. Where, for example, IPON allows you can submit a statement of work to show what you want to use the money for, and they'll give you up to $35,000 to cover up to 80% of your legal fees to implement whatever IP development you want to do. So there's a lot of free money out there that you can use that won't dilute your cap table at all. There's obviously, you can go to the bank, they can provide you loans against your assets or something like that. It's definitely not something that's going to dilute your cap table. There is crowdfunding. Crowdfunding can sometimes be good, sometimes bad. But it depends on where you're doing it from. We often see people not using crowdfunding. I don't know if it's the most effective method. All to say that it's available as a resource, but it's definitely not the most common one in the startup and venture capital world. And then thank you so much, Nafis. Appreciate that. Thank you, Kate. So there's a couple of resources that are going into the chat for things that we've talked about right now. Kate, if you can throw like the shred stuff in there as well, that'd be great. So then there's dilutive fundraising. So this is when you're issuing equity or you're issuing some like a certain instrument that can one day be equity. So that could be convertible notes and safes. So there's a couple different sources of capital. Kate, if we could just go to the next slide there. There's a couple different sources of capital at the early stages that you can look at. So as mentioned, there's founders themselves and friends and family. This is typically like a much, much earlier stage. So the key, as mentioned, is that people investing in your company understand the risks and expectations. You know, nothing is a sure thing. I think I can't tell you how many times I've heard it, but like investing successfully in a startup is kind of like winning the lottery, right? Like there's a lot of people that a lot of the investments don't work out, but there's some that end up being unicorns and they're great. But people should know that it's a risky investment, and if you're going to put in $5,000, $10,000, $20,000, $50,000, you should be okay to lose it if it doesn't work out, right? At this stage, there's not much diligence because honestly, like you just haven't done much other than working kind of on setting up your MVP. And it's more an investment in the founders and an investment in your vision and the reverse vesting agreements, making sure that you're there for a long while. They want to see that the founders invested in the company and they're fully committed. Not always fully committed because a lot of people start these when they have other jobs, but they want to see that there's an intense focus on growing this. There's angel investors. There's a humongous network in Canada, in the USA, that they look at the earliest stage of a company and they want to get in at the ground. They typically don't. They do smaller checks. They won't do large checks that will probably happen at your Series A plus, B, C, whatever. They want to get in a safe or in a convertible note, or maybe at your seed round. These are typically consists of a lot of like high net worth individuals. Honestly, like in San Francisco, it has like the highest millionaires per capita, I think, in a certain city. A lot of them are people that worked at companies, had options, they vested, they exercised them, and then sold them a couple of years later, and they just have a lot of money and are looking for other startups to invest in. That's just kind of the ecosystem there. And it's a very similar ecosystem to here as well, where there's a lot of people that just have a decent amount of money and they want to fund startups at the earliest stage and be part of the growth. Once again, high risk, but high reward if it works out. Diligence can vary. Nowadays, in the market, there's a lot more diligence than there was, say, 2 years ago. 2 years ago was kind of a frenzy where everybody wanted to invest in any startup that had some potential. So people weren't doing much diligence because it was very competitive. Nowadays, we're seeing diligence taking up months versus like weeks to before somebody decides to cut a check and be part of the company. Similar to the friends and family, they often focus on the relationship and the history of the founders, and like kind of what the industry application is going to be. Ayed's asking if it's relevant to go through an incubator or accelerator. The right one, yes. There's a ton in the city, being the city of Toronto, but like a ton everywhere. There's some that are kind of sharky, for lack of a better word. You know, there's some people that will ask for like 25% of equity. You're like maybe 10% just to show with the premise that, hey, we're very well connected, we can connect you to other people. There's some that have, you know, very, very good intentions where they want to help grow, somebody like Y-Space, Antler's a great one, DMZ, CDL, places like that, where they'll go and they have like very well established relationships that you can kind of rely on. So if you are go through an incubator accelerator, that's fine, but you definitely want to do your research and make sure you're going through a reputable one. And the best way to do that is just to honestly talk to other people in the ecosystem. A lot of startups that they went through the grind a couple years before you, they'll have a lot of war stories for you, and they'll be able to tell you who to avoid and who is a good resource and who's reliable. And yeah, you can definitely use it to raise money afterward. Like once again, a lot of these people will, a lot of incubators and accelerators want to come in on the ground level, pre-seed even. So they might not invest in a later round, but they'll definitely hopefully give you like a check size that's enough to like kind of get you up and off the ground running so that you can approach the market later. So just moving on sources of capital, I do want to make sure we get through all the fundraising here. There's venture capital and PE. This is like a bulk of the world where like these are professional investment funds. They just look for companies to invest in. They're out there in the ecosystem trying to meet as many people as they can. They review hundreds of pitch decks a day. These people are looking to come in at generally probably like an immediate post seed or maybe a seed followed by a series A or something like that. And they'll want preferred shares and certain rights that come with the preferred shares. So they'll want information rights. They'll want to sit on your board. They'll want certain approval rights to do certain things. Like I said, if you're going to issue more shares that dilute them, they're going to want a block on that. Say like, okay, you can't do this without our permission. We have to sign off on you further diluting us, things like that. Due diligence at this stage is going to be quite more extensive. So you want to make sure that you're in a position where, your corporate hygiene is on lock. Here at Fasken and generally us as a team, we really like the companies that we work with to have very good corporate hygiene. So from the outset, we're kind of helping you update your virtual minute book, making sure that everything's recorded so that, when you get to the point of a preferred share financing, it's not a red flag and you don't have to expend extra resources to actually to get what you're looking to do done. So I've been on deals where there was a lot of corporate cleanup required and it could have delayed it by 2 weeks and added hundreds of thousands of dollars to the legal bill if it's messy enough. I've seen that. So to the extent that you can continuously maintain corporate hygiene from the outset, it's definitely advised to do so. Lastly, we have the strategic investor. This is generally like somebody that operates in the space that is looking to invest in your company as part of its business strategy. They're typically a customer where they'll also want like certain rights in connection with their investment. So these rights could include like an exclusivity, an exclusivity clause where like they can be your only customer, or they'll say like you can only sell to XYZ in this region and XYZ in that region. It's not always the case, but sometimes it is. So you kind of want to be a bit more thoughtful of such investments. However, on the flip side, a strategic investor could also lead to an acquisition, where they'll want to buy out your company, or they'll often ask for a certain additional protections, like an additional right of first refusal on sale, because they'll want to buy the company itself. So a good example that I can think of is I worked with this computer company, and they got one of the investors that came in was like a high level car producer, and they wanted to invest in the company because they wanted to get a special price on the technology for their cars. So that's kind of the best example I could give of a strategic investor. And then the next, if we're just move on to fundraising, onto the next slide there, I want to talk about safes and convertible notes. So I'll spend a little time here, but a safe, it's an acronym for Simple Agreement for Future Equity. It's a standardized template that everybody, at least in North America, uses. There's people across the pond that use it as well. but it's a very popular instrument here in North America because it's an industry standard template. There's very few differences between the USA safe and the Canadian safe. And the idea is that it's a quick way for you to get money into your company, whereby hopefully all the lawyers that are dealing with it understand that it's a template and it should not be changed much, if at all. And it has certain rights in it that allow it to convert into equity in your company with once certain like triggers are met. So there could be like a qualified financing. So to be like, the day I raise $5 million as part of a preferred share financing, your safe will convert, right? And it'll convert based on this mechanic, or I'll give you a discount of like 20% to whatever the preferred share financing round is. There's certain like key terms that go into it, like the valuation cap, which we just mentioned, where the valuation cap could be like, oh, the day I raise $5 million or my company's worth $20 million or something, then it'll convert. There's that discount. The MFN is what's called a most favored nation. So it's essentially saying, because it's a very early stage in your company, it's if you're issuing me a safe today, if you issue a safe sometime in the future before preferred share financing with better rights or better like conversion mechanism than mine, then I'm going to get those same rights, and you're going to change my safe into that safe. So this often gets negotiated. As a company, you probably don't want it in there because like you might have somebody that wants to come in on better terms. But as an investor, if you're putting in a certain chunk of money into a company, you might want to make sure that you're getting the best deal now up until it actually converts. We have seen situations where companies that didn't have proper legal counsel accepted safes that were highly manipulated, where they somehow worked in a perpetual MFN right post preferred share financing. So those are things you kind of want to look out for when you're out there in the market seeking funds. It defers your valuation from that point in time. So saying it'll convert once I have a $20 million valuation, but I don't have that today, but that's when it'll convert. So the valuation is determined. There's usually a variety of factors. There's like if you go to Y Combinator, they'll have suggestions of what to value your company at different stages of depending on what's going on. So it's honestly a bit of a magical made up number that companies come up with, but it follows some type of principle. And then there's the convertible debt. Oftentimes it's just a convertible note. It's essentially a safe, but it has a concept of interest and a maturity date. So with the safe, it can remain outstanding up until there's an actual financing at any given point. That could be 6 months from now, a year, 2 years, 3 years, or never in the worst case scenario. Nowadays, when it's not the same market that it was a couple of years ago, people want some assurance that they can get their money paid back to them. So they'll invest via a convertible note. The convertible note has the same rights of conversion where it'll say your note will convert into equity in your company based on these conversion mechanisms. And it's typically same thing, a valuation cap, a qualified financing, or a discount. Sorry. However, it has a concept of interest. So like I'm putting $50,000 into your company. This $50,000 is going to have interest, 10% interest on it on an annual basis. And if it doesn't convert within 2 years, you'll pay me back my principal plus interest, right? That could be the simplest form, but depending on the market and how badly your company needs money, it could be if it doesn't, this is going to convert 2x times the principal. If you don't pay me back, if it fully matured, then you're going to pay me back 3 times what I paid you, plus any interest that's accrued. So all to say, it's not a standard instrument like the safe is. The safe is highly agreed upon that like, all right, we might have to do like some small tweaks and manipulations to this, but it's one template. We're all understanding how this works and how this money is going to come into your company. So everybody uses, in most cases, not all cases, but in most cases, the most standard template. With the convertible note, every law firm, every lawyer has like a preferred form. So there's oftentimes a lot of negotiation that happens, which makes it legally more expensive to put together and to successfully carry across the line. So I'll say a safe converts into equity, a convertible note also converts into equity, but if it doesn't convert within a specified time period, they can get their money back, and the convertible note itself could be a secured note where they'll secure it against any assets the company has. So there might be some form of a general security agreement with it, or it could be an unsecured note where they'll rank a bit lower. So like I said, there's just a ton of variations that make it not a standard approach that can make it more expensive. And finally, the big one is going to be the priced round. The price round itself puts a valuation on your company. It's typically led by venture capital firms, private equity shops, or strategic investors. In most cases, it's going to be the venture capital firms that are investing. It's not going to be your first round of financing, typically, not always the case, when depending on like your reputation as a founder. So there's serial founders that, they've had successful exits and have like a good presence in the ecosystem. They might, I've seen a situation where they go to a fund with an idea and like, all right, we want to give you 250K, 500K, $1 million right away to get this going. It could be right away you incorporate it and you have a preferred share financing. This is an anomaly. It doesn't happen often, but it's something that does happen. So it's not always going to be your first round of financing. It's not typically a first round of financing, but could be. It's in your interest not to do this right off the bat, because obviously the more metrics you have to show the value of your company, the better valuation you will get on your company, and that's only going to grow with time. So there's certain timing elements to this where it could be too early, it could be the right time, or you might have waited too late. But that's why we're here. We're here to help out with these things, if and when it's the right time. Next slide, please. Once again, similar. Yeah, the recording will be shared, from what I understand from Alina said. If you recall early in the presentation, we talked about those 3 main shareholder agreements. So those are basically that's the market structure to these. All the rights are going to be negotiated in your investors' rights agreement, your voting agreement, and your right of first refusal and co-sale. And then any additional things will be in the share purchase agreement and the actual articles. So a bunch of rights and stuff will be put into those. Those will be fairly market standard. It's evolved from, once again, it was a Silicon Valley thing where they wanted to figure out a faster and cheaper way to do these. So they implemented like a standard set of documents that everybody agrees to use as templates. These obviously evolve over time and get renegotiated and renegotiated. And this is where you're going to be selling preferred shares in your company. So if you guys are familiar with the industry terms, there's the seed recording, there's a Series A, Series B, Series C. If anybody watches the show Silicon Valley, they kind of, it's a funny show, but they kind of allude to it pretty well in terms of how fundraising works. And oftentimes the things that get negotiated, as I mentioned, is like voting, conversion, anti-dilution, protective provision. So it's kind of everything we talked about in the earlier documents. They just evolve. So you start thinking about dividend rights when you're getting closer and closer to potentially a sale of your company one day, right? So if somebody's coming in at a distressed time, they might want a higher dividend rate. And oftentimes it's 1x, but it could change depending on the market. So these are the things that are going to get negotiated when you're doing a preferred share financing. And as your company evolves from B, C, D, these will get more and more unique and specific to your actual company. I'll shoot it over to Kate to speak a bit about like a couple of good practices, and then I do think we have a little bit of time left. We're kind of getting close, so she'll run through that, and then we'll answer some questions.
Yeah, thanks, Satnam. I realize we only have 2 minutes left, and I do want to be respectful of everyone's time here. I think we've learned a lot, but I just want to really stress a few things about just preparing for a raise, because if you've never done it, there are definitely some key things that you'll want to know. I think we've talked a little bit about doing due diligence and having due diligence done on your company, but the things that I really think are important here is, before you actually go out to market, figure out how much you want to raise and where that's going to get you to. When I was still venture capital side, a lot of times what I would ask companies is, well, what do you plan to do with this money? And the companies that I tended to fund, they would say, oh, here's our plan. We think this is going to give us 18 months of runway. We want to spend, 10% on hiring, 15% on whatever, things of that nature. It's always good to go in with a plan, even if you're super early stage and maybe you haven't really figured it all out, that is fine. Before you talk to a VC too, prepare your data room. So I think we touched a little bit about data rooms, but basically it's an online hub where you can put in all of your key documents, because even those angel rounds, your VCs are going to want to do some light due diligence, make sure the company is structured, make sure there's shareholders agreements, and all of those documents sat and talked about. If you currently have investors, talk with them before you go to market. There's nothing worse than going out, talking to a bunch of VCs. And I will tell you the worst kept secret. We are the worst gossips. We all talk to each other. I know whose companies are raising right now. I know who's running out of capital. Like, we're terrible, terrible gossips. And so basically, what you want to do is talk to them. One, see if they want to exercise pro rata to keep their investment in the company and keep their equity stake. But then also, make sure that they can help you. Make sure that they're aware you're raising so they can open those doors. One of the things that you'll see investors do is I'll make friends with the investors that are at the stage after me. So Series A, B, whatever. And the companies that I think are going to succeed, I'll be like, you know what, you should get to know these folks. They're doing really well. And also just think about how your today is going to impact tomorrow. And what I really mean by that is, if you bring on investors today, they're going to impact your future rounds. It's either going to be impacted by a dilution, it's going to be impacted potentially around who sits on your board. You want to, one, make sure that you're comfortable with these people, but two, make sure that they're able to add value and that they're going to scale with your company. There we go. I'm not going to talk about due diligence because I think we could spend honestly a whole hour on just this, but these notes will be sent around afterwards. But basically, the kind of things that you want to think about when you're going through due diligence, making sure you're using a good platform, making sure your data room's up to date. There's nothing worse than chasing a founder for things that just are basic. It also makes investors think are these folks really on the ball? Set aside an afternoon once a quarter and just go through it, make sure things are up to date. And then, don't be afraid to ask investors questions about this process. Don't be afraid to say, what does the timeline look like? What things are you going to be looking at for our company? Because each investor is going to have a very different perception. And depending on what space your company is in, they may look for different things. The one thing I am just going to really point out here with going through this process is, if any investor asks to look at source code or anything very proprietary to the business, that is a hard no. You do not want to do that. It may come up, especially if you're in a very technical industry, and I see it mostly in things like healthcare or the deep tech, where they say, hey, we want to take a look at it. They should be using what is referred to as a third party. That is a clean entity that does this professionally. So they're going through, they're doing the checks and balances and saying, yep, this company's good, go forward. The other thing I'll highlight here too is never ask an investor to sign an NDA. We just don't do it. I often like to think of it as doctor-patient confidentiality, attorney-client privilege, pick your favorite. And basically what that means is anything you tell your investor going through the due diligence process should stay with them. They should not be going out and telling other people. So while I say we're the worst gossips, we also do keep things close to the chest. So you'll hear things such as, oh yeah, I'm looking at this company in the AI space, but they're not going to go out and really give away what your secret sauce is. So don't be afraid to tell them things. But if you slap down an NDA, I think I can count on one hand how many NDAs I have signed as an investor, and I think it's probably 2. All right, let's open the floor. I realize we are over time here, but do people have questions? I see there's one from Bianca here. They shouldn't ask them to sign an NDA, or no? Oh, no, do not ask them to sign an NDA. Nobody's going to sign an NDA as an investor. Save your NDAs for when you're going through commercial work or things of that nature. Does that make sense? I always highlight it because it comes up it comes up a fair amount. Like, oh, we need an NDA to give these people. I'm like, no, you don't. They're not going to sign it.
And you should be able to just disclose enough information that they have they have enough to consider whether or not they want to invest in your company. Once again, when they're ready, there is going to be a due diligence process. But there's going to be confidentiality provisions built into the term sheet and stuff like that. So it's not something you have to work out about. There is, I do think, oftentimes to Kate's point, we just hear everybody saying oh, we need a form of NDA because we're thinking about doing this, we're thinking about doing that. If it's commercial, sure, 100%. But often in this space, if you start throwing out NDAs to investors, they're just not going to bother.
Yeah, it's too much work. And I think it's Layla, but sorry if that's incorrect. To your point, how do you connect the company? Or protect rather. So basically, anything that you're going to be putting in your data room, while it is confidential, you're not putting any sort of strong IP for the company, right? So usually when I build out data rooms, or if I'm looking at a data room, I'm looking for things like shareholders agreements, who's on the cap table, is the company structured correctly, meaning do you have shareholders agreements in place, you have IP assignments in place. So you're not saying, okay, here is the algorithm we use to develop this product. You're not giving them that sort of data.
I want to see you own the IP, that you've properly registered it, things like that.
Exactly.
It's not oftentimes that they'll ask for source code, and if they are, then there's probably a red flag there.
Yeah, you back away slowly from those people. The one thing I'll say too is I just see somebody mentioned, okay, we send a term sheet, but before we send any numbers and info about the company. So these things may happen in tandem. I think from my point of view, especially if you're in spaces like fintech or anything that could be potentially highly regulated, some investors in the later stages, they're going to ask you about contracts, right? They're going to be like, well, who are you working with? Do you have relevant contracts? What you can do is you can basically show them who's in the pipeline, and you may go through this during the deep due diligence process, but what you're going to do is you're going to strip out who the clients actually are. So for example, I've seen pipelines that have bank as a client or Canadian fintech, and you're not giving away who the client is at this cadence, but you're giving them a sense that you do have, things in the pipeline. But yes, no recipes, no source code, anything very proprietary to the business, hard no.
And just to address the earlier point, once you do sign that term sheet, they will want to see everything.
Yeah.
So at that point, you'll just drop your agreements into the folder and everything. So I do think we're a bit over time. Please, all of our contact information is going to be in this. So please do reach out if you guys have any questions at all. Thank you to YSpace for hosting this. And thank you to all the participants that chose to attend.
Thank you so much, Satyam and Kate. This was fantastic. As always, it's always amazing to collaborate with Faskin. To everybody else, thank you for joining us during your lunch hour. We will be sending the recording and the pitch deck with you by the end of the day. Thank you so much, everybody, for being here, and we'll see you in our next session on July 31st. Bye, everyone.
Everyone.
Thanks, Kate and Satyam, again.